From losing his home during the depths of the Great Recession to building a company from scratch to over $250 million a year in volume, my guest today is Jason Fritton, co-founder and CEO of marketplace lender Patch of Land. Welcome to the National Real Estate Forum podcast, episode 225. Thank you for joining me today. I am Dr. Adam Gower, and this is the nationalrealestateforum.org, where I speak to leaders of the crowdfund real estate industry so that you can learn how to raise capital, build wealth, and earn passive income from crowdfund real estate deals. Giving rise to the crowdfunding real estate platforms that I'm covering in this series of podcasts was, as you already know, the Jobs Act, passed in 2012. The Act was designed to be a solution to the failure of public markets to provide liquidity to small companies. This has itself been brought about by earlier regulatory changes designed to protect the investor. It's a long story, and I cover it in depth in my book, Leaders of the Crowd, due to be published by Palgrave Macmillan later this year. The short story is that to facilitate the capitalization of small companies, the Jobs Act included components that allowed for a simplified version of the IPO light as David Wield calls them, the man known as the father of the Act, as well as regulations CF for crowdfund and Reg D 506C. In all cases, public solicitation was made permissible, which was a fundamental change from the pre-Jobs Act era because it allows open advertising on the internet. Remarkably, though, as far as I can tell from my research, the idea that real estate could benefit from the Jobs Act was not once contemplated by the Act's authors. And so crowdfund real estate is an unanticipated consequence of the Jobs Act, and yet has been the single largest industry beneficiary. To cover the latest event, to produce a news digest exclusively focused on crowdfund real estate. You can subscribe to it absolutely free at the show notes to today's episode at the nationalrealestateforum.org website, nreforum.org/POL for Patch of Land. My guest today, Jason Fritton, co-founder and CEO of the online CFRE marketplace Patch of Land, was one of the earliest adopters of crowdfund techniques to bring liquidity to real estate markets. What makes Jason particularly notable in this respect is that he had no background in real estate when he decided that the Jobs Act was an ideal vehicle for financing real estate deals. What makes him doubly remarkable is that the Act was not written with real estate in mind, as I mentioned. I've included links to Jason's site in the show notes to today's episode at the nationalrealestateforum.org website, nreforum.org/POL for Patch. Nationalrealestateforum.org website, nreforum.org/POL for Patch of Land. Why don't you tell me something about you and your background and how you ended up in the real estate corner of fintech?
Well, to be honest with you, Adam, I didn't have anything to do with real estate when I began this company. It was a somewhat aspirational, somewhat naive goal of mine to start a real estate company, but I came into it with absolutely no knowledge beforehand. My background is more on the technology side. I worked basically providing solutions on the telecommunications side for very, very large public sector clients. And I did very, very well with that and built it into a nice company that I owned 100% of. And unfortunately, in 2008 and 2009, when the financial crisis hit, I learned my mistake in having just a few clients or one very large client. That when that client went away, my company went away with it. And that was extremely painful for me. I lost everything on that. And so I wanted to do something again, because once you start a company that does well, that is what you're going to do for the rest of your life. It's in your blood at that point. And so while I had to take a day job in deciding what else I was going to do next, I really wanted a company that would have thousands and thousands of very happy, loyal customers and clients. And I had known the CEO of a company that was doing crowdsourced graphic design. And he was just blowing up the entire industry and doing very, very well. And I said, this is the future. This is how things are going to move. We're so interconnected today that the ability to be able to reach out to people that you didn't have any sort of previous relationship with and be a difficult project was very, very powerful. And to be able to make it simple, to be able to move them forward in the same direction at the same time, to be able to accomplish something great was really exciting to me. And so I sat down, honestly, with a scratch pad on my couch one day, and I said, okay, well, how would this type of thing work in a big, scalable, fun sense? And one of the biggest things that was really traumatic to me about losing the company beforehand was I lost my house. And a lot of people really take for granted just how nice it is to have your own place, your own piece of the planet, your own patch of land, which is where I came up with the name. And real estate just resonates with people. And deep down, everybody wants to feel like they have some corner of the earth that is theirs. And so I didn't know anything about real estate. This was back in 2010, kind of the depths of the market. I went and took a look at the auctions out in Chicago. And so I didn't know anything about real estate. This was back in 2010, kind of the depths of the market. I went and took a look at the auctions out in Chicago to see what type of opportunity was out there. And I found that there was always just kind of the same 12 guys at this particular point that were bidding on good properties. There were smart guys, the highly experienced guys, wealthy guys, but always kind of the same small group of people that were on a first-name basis, a very insular group. And one of the first auctions I went to, there was a property that came up in my neighborhood at the time that was nicer than the place that I was living in. I think the current appraisal on it was $300,000. $300,000. It's nicer than the place that I was living in at the time. I mean, by today's standard, after the recovery, it's probably worth $600,000 or more. But back then, the appraisal had it at $300,000. The minimum bid on it was $20,000. Right? $20,000 on a $300,000 opportunity, and nobody but all knew each other, were highly experienced, and were at all those auctions. They were bidding on the big properties, the multi-million-dollar properties, and the small properties that I consider to be kind of the bones of real estate were a little bit beneath their attention at that point. But because it was the depth of the housing crisis, nobody else had the money, and banks weren't lending. Private lenders really had massive liquidity problems. And the individual contractors, individual real estate professionals didn't have access to that type of capital. So this great property went back to the bank and was abandoned. I said, that's a real opportunity. And I went to my attorneys, and I went to a bunch of mentors that I trust, and I said, this is what I want to do. And without exception, they told me it was a great idea, and it was something that they would be really excited about it, but if I did it, I was going to go to prison. It was, going to take this and put it online from the internet and ask for, investors. I'm going to take this and put it online from the internet and ask for, investors. And that's public solicitation of security.
Okay.
Most people don't realize you can't just...
Right. So this was before the Jobs Act, right? Sorry to interrupt. My wife always tells me I shouldn't interrupt. This was before the Jobs Act. Okay.
No, you'll have to. Okay. I apologize. I'll get long-winded from time to time.
No, it's fine. No, I'll get into trouble at home, though, if I do too much. So go for it. It's all right.
Fair enough.
All right. So I see it. So I get the time right. So you could, right. So what you're doing now is you're advertising, but then you couldn't do it. So, all right, go on, continue. So how did that process evolve then? Yeah.
Well, I tend to be a stubborn guy. I try and find, that's my particular skill set, is I try and find solutions to complex problems. At least that's a good way of saying I'm just bullheaded and very, very stubborn. So I found out that there were a couple of Congress people that were co-sponsoring what became the crowdfunding exemptions to what became the 2012 Jobs Act. And I worked to advocate for, indicated his willingness to sign that bill. I put together a patch of land full-time in an incubator space out in Chicago. And the rest is history. We've gone from that little tiny company that I built from my couch to, we've got a run rate of about $1/3 billion now in annual lending, and we'll probably be pretty close to $500 million in run rate by the end of this year. It's been exciting. And I started from not knowing anything about real estate, and now at this point I've reviewed billions of dollars worth of opportunities.
All right, that's really interesting. All right, so tell me how you went from the steps of an auction house to the seed of an idea in an incubator to a $300 million a year underwriting finance company. So tell me actually about the financial path, because I know you have quite an interesting path, don't you? So from a seed startup perspective, tell me how you financed your growth.
Mm-hmm. Honestly, it begins and ends with a lot of hard work and just determination. And so when I first started, we were fairly new with this particular idea. I mean, providing access to real estate to people who may have had no private experience whatsoever. And the goal was to allow people to invest in real estate from 2 minutes flat, from their phone, from their couch, from their pajamas if they want to. And that was exciting to kind of the wider public. And so we started doing some press demos. I put together a little tiny team at this incubator space, and we just got basically a minimally viable product going. Just the absolute minimum of what we would need to be able to get business done in a very minimal sense. And we started doing some tech demos. We started to get a little bit of press about us. It kind of grew organically at that point, but it wasn't something where we just boomed and took off and the Wall Street Journal picked up on us or anything like that. It was very, very kind of, homegrown.
Tell you what, let me jump in if you don't mind. I'm very interested in that minimum viable product. Can you describe that a little bit? And the reason that I ask, this is an interesting direction that our call is taking a little bit, because I'm actually also based in an incubator myself and surrounded by startups and seed companies, invested in a couple of seed companies. So tell me, just before we jump to the rapid growth phase that you had, what was that minimum viable product? What did that look like exactly?
Right. So, every entrepreneur has huge dreams, or you wouldn't be an entrepreneur to start with. And of course, along with every huge dream comes every bell and whistle that you can think of that's going to be great for your customers. The problem is, if you go that route right from the very beginning, you end up with this development paralysis, essentially, where you never get the product perfect. It's not exactly what you envision in your head, and you delay launching until the opportunity has passed you by. So on our side, we really just wanted to put together basically a framework online that would allow people to review good real estate opportunities and then place a commitment within them. That was the base of the problem we were solving. We wanted 1,000 people to be able to come together, put in a little bit of money into an opportunity to be able to make a big opportunity happen that wouldn't have been possible with these folks individually. And so our minimally viable product was really just that. It was the ability for somebody to view a real estate opportunity online, be able to review the due diligence, and for us to upload docs and everything to show why it was, a credit-worthy, good project, and then be able to place a small commitment fractionally and have that tracked. So we did that, and once we accomplished that, the story becomes real, right? Because for an entrepreneur, what you're trying to do may be very clear in your head, but one of the biggest challenges to getting something off the ground is communicating that to other people and getting them to believe in it. And so you have to be able to show somebody relatively quickly, you have to show the wider public relatively quickly that what your idea is, what exactly is the value of it. And so we were able to show, great, somebody can come in and put a tiny little bit of money into real estate and be able to own real estate across the country, and they can do it from their phone. And that was enough to get some articles written about us. We hadn't done any business at that point, but it was enough to be able to say, hey, look at these guys over here. They got this kind of cool little idea. And it blossomed from that because, honestly, you never know who's looking at those type of articles. And somebody else made sense to me. And that person was Carlo Tabibi, my co-founder. He's has a very prominent, powerful family out in Beverly Hills. And he's done hundreds of millions of dollars worth of real estate on several different continents. And so he came to us and said, well, listen, if you're willing to relocate out to Los Angeles, I'll put in a few $100,000 worth of seed capital to get us started. And so we started from this very, very simple idea, not doing any actual business, to getting somebody to believe, the right person to believe. And that took us to the next level. And from there, we were, at that point, I couldn't take my Chicago team because they have families and they have lives in Chicago. So it was really just my co-founder and myself. We came out to LA and we kind of put another team back together. Lives in Chicago. So it was really just my co-founder and myself. We came out to LA and we kind of put another team back together. And we did that very, very slowly. and we did basically all of the work ourselves to begin with. We worked 16, 18-hour days every single day, 7 days a week, to try and get this thing ready in anticipation of launch, and we did that. We showed up in Los Angeles in, I think, September of 2013, and we launched the website with our first little tiny opportunity in October of 2013. And I remember we were set to go speak at a trade show. Because of the uniqueness of our idea, we were invited. And we launched our first project right before we jumped in the car to go out to Las Vegas to speak at this trade show. We expected it to take 30 days to fund. It was only a $100,000 or so project. We expected it to take 30 days, funded in hours. And that presented its own problem, because you don't want to be, have dead space up there where you don't have anything new for investors to get involved in, and they lose interest. We had to crunch while we were out there in Vegas to find a new opportunity to launch. From there, we picked up speed. We really did operate in kind of a beta sense. I mean, when we're having an investment company, especially a real estate investment company, especially a real estate investment company where the founder doesn't have a whole lot of real estate experience, we wanted to take things slowly to make sure that it's other people's money we're operating with here. We need to be able to be cognizant of that and respectful of that. And so we operated most of 2014 in kind of a beta state and really put the system together. We really wanted to be scalable, essentially. A lot of real estate companies, a lot of real estate lenders are built around a few folks, men and women that have been in real estate for a big book of business, and they operate off of that book of business. But they really don't have the ability to grow far beyond that without finding other men and women who have that type of book of business themselves and getting them to come to their company. I really wanted a system to where we could generate the book of business internally with a very, very strong conversion funnel on externally developed leads. And then be able to have a strong group of smart people internally that we've trained up into our products and into our system that could convert and close those leads and be able to handle our clients respectfully and efficiently and with a very positive experience. And so we spent 2015 and 2016 building that system.
For the only news digest focused exclusively on the crowdfund real estate industry, please subscribe for free using the link on today's show notes page at the National Real Estate Forum.org website, nreforum.org/POL. You also raised some venture capital, didn't you, at some point, some fairly substantial amount. Can you tell me a little about the pathway to that? I think you did a Series A, which means that you also did a seed round. Was that with your co-partner in Beverly Hills, or was that subsequent? You did seed rounds and then you went to a Series A?
Well, the seed round was my partner in Beverly Hills. That was with Carla. He provided the seed round, a few $100,000. Then my Series A was, we went the traditional VC route. And that, for the folks who listen to this who have never been through that before, is quite an undertaking. It is exhausting. You have to convince very, very smart people that not only do you know what you're talking about directly, but that you're and to do it in a relatively quick time frame. So it's very, very challenging. It can be very discouraging because I think most VCs will take a look at 100 different companies before they give one yes, which means that, let's say all things equal, a company may get 99 no's before they get one yes, assuming they ever get a yes. And so we went out to raise capital. We went to Wall Street. We went to Sand Hill Road. We went to family offices. And that's eventually what allowed us to get a lead for a round. So we found a very prominent family office that was also involved with other marketplace lenders like Avant and On Deck and other companies in different asset classes that had experience with it. And they promised us a good amount of capital to begin with. And then I went out to my crowd. A good amount of capital to begin with. And then I went out to my crowd. Now, the nice thing about building a crowdfunding marketplace lending type company is you end up with a great deal of very happy customers, assuming you're doing your job right. that tend to have significant resources of their own. And the entire, the baseline idea still stands, whether it's, you're funding real estate or funding a company, that a small amount of capital from a whole lot of people adds up very quickly. So we were able to produce the Series A with a very sophisticated lead from a big family office, and then fill it out with our clients. I mean, they're the best investors because they already know what you do, and they've had an experience working with you, and they're happy with who you are. And that's a big advantage that we have even today. If we ever get in a position where we need capital, I have thousands of investors on the platform right now. I can say, hey, do you want to own a patch of land? And potentially raise capital, as long as I can show folks that we've got a good plan for making them a positive return on their investment.
All right. Now, you raised about, as I recall, about $26.5 million in that Series A. Is that right?
I think it was right around 23.6.
23.6. So what did you use that for? Because now you've got, you're describing a path from a few $100,000, a small group of professionals, right, that you've successfully persuaded a family office and some investors to invest. How did you use that? That's a huge amount of money to use for the growth of the company. What did you do with that?
Well, the 23 and change was actually built was composed of a combination of debt and equity. So some was a straight cash infusion, and then an additional amount, a larger amount, was our first real pre-funding line.
Okay.
So when we create an opportunity with a real estate developer, we have to move fast. And we can fund a deal in a property in 46 states in as little as a couple of days. But to be able to do that, I can't immediately go, have it staged and up on the website and go out to investors and have them fund and then wait for their money to come in. And that's not really workable. So we have to be able to use our own capital to fund the property to begin with. And so depending on how quickly we scale, if we're doing 20 or 30 or $40 million a month, we have to have that amount of capital available necessary to fund the deals to begin with. So then I can take it out to our investors. And so a good amount was used up in that capacity, or earmarked for that capacity. And then a good amount of capital was just used to reinvest in the company. We needed staff. We needed offices. We needed marketing materials. We needed marketing channels. We had trade shows. We needed press releases. Most people don't realize how quickly money goes when you're a new company. It's a huge, huge achievement to eventually get to be cash flow positive.
What did you find the more challenging? Was it finding the deal flow from developers, or was it generating the investor base?
It was both at different stages of the company. Initially, we had a decent amount of opportunities to be able to fund, but we had no investors. So we had to get new investors on board, because you can't promise a real estate professional that you're going to fund their deal where they may have earnest money down on it if you don't have the investment backing to make it happen. But at the same time, capital. Just like any small company, we needed money to be able to make these opportunities actually happen. And it can be difficult advertising for this type of opportunity. So we had a constraint in capital initially, both on the warehouse lines, for pre-funding, and as well as just investment capital from our investors. I can't do a $10 million deal if it's going to take 2 years to be able to fund while it's sitting on the website. So that was a constraint. Then once we started getting a lot more attention, we started to grow organically on the investment side. We were producing around an 11% return, backed by a solid hard asset that was worth more than the investment to start with. So that was a very, very appealing product. And once our investors started to see a good return on their investments and be able to get their money flowing in every single month, they would tell other folks. And it would grow very organic investments and be able to get their money flowing in every single month. They would tell other folks. And it would grow very organically from that rate. So eventually you get to the point where that balance started to tilt towards we have too much money and not enough product. And then we have to take internal capital and market it back out and find out how to reach out to what can be a very insular group of real estate professionals to be able to get, the opportunity to work with them. And then it goes back and forth depending upon what stage of the company you're in. Today, we have billions of dollars worth of capital commitments, and we can fund pretty much as much as we can get in as far as solid opportunities are concerned, as long as they're good opportunities. We get a lot of applications for folks that have big dreams but really don't have a good plan for how to make their project happen, and unfortunately we can't fund those. But today we're definitely constrained on the deal flow side as opposed to the capital side.
Okay, now, and today also, please also tell me, if you have so much capital, why it is that you're not looking at other types of deals, including equity or longer-term lending, or perhaps if you are in fact looking at expanding. So starting with what you currently have on the books and how you're thinking of changing that, if indeed you are.
We work with construction opportunities with real estate professionals on non-owner occupied properties. So a lot of what can be called, say, a fix and flip, or a fix and rent, or a refinance to rent. We deal with folks that know what they're doing in real estate. And I can go back to my investors and be able to say this person has a reasonable expectation of being able to pull off this project, primarily on single-family residential and small multifamily, although we're now branching into small balance commercial as well in the $1 to $5 million segment. And we're also now doing small multifamily, although we're now branching into small balance commercial as well in the $1 to $5 million segment. And we're also now doing new construction in specific markets. And we're going to be expanding aggressively as we continue to develop our skills and making sure to adequately underwrite additional markets for that type of product. We do want to move into long-term. We've been constrained on long-term in the past because we've been working with the crowd. And the crowd doesn't want their money tied up for 5 years or 7 years or 30 years. But that's 85% of the market, so it's absolutely a priority of ours. And as we've grown, as we've developed credibility, we've been able to engage in interest billion-dollar Wall Street firms. And those firms are taking a look at our loan tape and our underwriting criteria and the viability of the company itself, and they've been able to say, okay, listen, we'll have that in place within the next quarter or two.
What kind of product is that? Can you tell me what it looks like?
Sure. It's a 5-1 ARM or 7-1 ARM, or a traditional 15 or 30 year amortized. Again, it'd be for a rental portfolio, a non-owner occupied. We don't want to move into owner occupied opportunities at this point, simply because when the regulatory environment is extremely burdensome. And when we started this, we started it because there was a massive fragmentation. There was a failing in this type of industry where the banks wouldn't lend on these type of opportunities, but it's a huge market, and hundreds of billions or even trillions, depending upon how far out in the asset class you go. But the banks didn't do a good job with it. So there's a huge opportunity. The banks do generally a pretty decent job with a residential mortgage. You've got Quicken and go. But the banks didn't do a good job with it. So there's a huge opportunity. The banks do generally a pretty decent job with a residential mortgage. You've got Quicken and so on out there. It does a relatively good job, and again, much bigger market. But the market that we're in at the moment is so huge as it is that even if I'm able to scrape together a tiny bit of market share, we're doing very, very well. And because we have a good position within the market, I think that we can actually continue to grow for a long time in the future.
Jason, when you talk about a 3-1 arm or a 5-1 arm, I hear two things when you say that. One, I hear, gosh, you're sounding very much like a bank. So my question is, well, what kind of rates are you looking at? And then the next question is, the second thing I hear is, all right, so what's the characteristics of the borrower? Because I understand the 1-year model, right, the debt that supports that deal. But what is the type of loan that you're looking at that's a 3-1? What kind of interest rates are you anticipating, and who's going to be your borrower?
I think that the borrower can be very similar to who we're dealing with in the short term. In fact, that's a big goal of ours. Our average borrower will borrow from us 2 to 4 times in a year, and they tend to grow into other projects. So depending upon the stage of the market, a fix and flip might be a great opportunity, but they might want to buy something that they put a lesser amount of work into, but they want to put a renter into, and they want to have it stabilized for a long period of time. So essentially, it's the same borrower, it's just simply a different project. And we're seeing that a lot, especially as the market's getting hotter and it's less easy to find fix and flip. We're seeing a lot of people move into the fix and rent.
That's interesting. These are still single-family homes, are they, Jason, then? This is somebody that wants to buy a single-family home, fix it up for a rental, and then sit on it. So, but will the rates stay the same, do you think? You're still going to get the same kind of rates as you will if they won't, right? So what are you anticipating? How are you underwriting that?
Well, so the rates can be significantly lower. Now, it's still a non-owner occupied, so they're not quite as low as your traditional primary residence bank rate, but they're not the short-term interest-only fix and flip rates either. So they're generally on the range of 5% to 7%. Though we haven't solidified that yet. In certain cases they can be lower, in certain cases they could be higher. But they're being designed to allow people to develop a good cash flowing portfolio.
So how much loan to value are you going to be leveraging with these new loans, do you think? So you've got two considerations, right? You've got loan to cost, so the entry, and then presumably these are all value add?
I think we haven't ironed that out yet. So
add deals. So you also have a loan to value metric as well that you're using. So how are you anticipating underwriting this new tranche of deal flow?
Well, I think we haven't ironed that out yet, so I apologize if I'm not able to give you as firm an answer as possible. Because we're a marketplace lender, we tend to originate to the criteria of our investment partners, unless it's going to the crowd, in which case we have our own underwriting criteria, which actually tends to be tighter than the Wall Street partners that we have. So if I have a partner that's interested in, let's just say, California rental portfolios, they'll do up to $3 million on a particular property, and they'll do a 70% LTV or an 80% LTV or even a 90% LTV, though I think that would be pushing it. Then we have the ability to originate to that credit guideline. So it really depends, and sorry for the somewhat trite answer, but it really depends upon the partners we're able to develop here in the long-term product. And considering that we're still in negotiation with it, I think it would be presumptuous of me to tell you with any authority what it is at this moment.
Okay, understood. And when you talk about partners, though, you're talking about investment partners, are you? This is not smaller investment amounts for many people. When you talk about partners, you're talking about individual investors who are willing to invest significant dollars, up to $3 million. Is that right? Am I understanding that right?
Correct. That's right. Our crowd generally is not interested in putting money, for 5 or 7 years or 15 years, at 4.5% or 5%. Our crowd really likes the 12-month opportunities at a 7, 8, or 9%.
Interesting. Okay. So let me ask you a different question, a kind of a slightly different angle. What are the most frequently asked questions that you get from people that want to invest from the crowd? And what are the most frequently asked questions that you get from developers or from fix and flippers, your borrowers?
I think that the borrowers primarily want to know how quickly we can move. Many of us understand exactly how hard it can be to get a mortgage. When you're a real estate professional, you're trying to do 10 products or properties a year or 100 properties a year. Think about how difficult that can be. So for the most case, our borrowers want to know that we can be reliable. If we tell them we can do something, we actually can then do that. And then 2, that we can move quickly on it. That is by far the biggest concern for our real estate clients. And we're very happy to say that we've been able to operate very, very well on that front. We can close it in as little as a couple of days at this point. And then on the investor side, when they want to know the credit quality, of the opportunities, how many are they going to lose their money? And we have performed amazingly well in that characteristic as well. And they just want to know basically the general characteristics of the investment itself. We find that a lot of our crowd investors really want to understand, they just really want to be able to wrap their heads around the investment. And I have crowd investors, everyone from a small town professional who's worked hard his or her entire life and has a good amount of capital that they want to be able to invest themselves, to individuals who have hundreds of millions of dollars that don't invest in anything that they cannot directly understand, and everyone in between. And everyone's risk appetite is a little bit different. Everyone's credit guidelines are a little bit different, so they'll invest in some things and not in other things. But because we have so many of them, everything that we've been able to launch has been funded reliably. But it comes down to basically understanding, whether it's a good investment. Basically understanding, whether it's a good investment on the investor side and when they're going to get their money back. And on the borrower side, it's, can you do what you're saying you're going to do, and can you do it quickly?
And when you talk about investors wanting to wrap their head around a deal, can you describe what you've found that process actually entails for investors across the spectrum?
Our model lends itself very well to being very easy to understand. I mean, because it's such a normal part of all of our lives, people understand that this is a place where somebody wants to live, and we have a professional coming in that's going to spend a certain amount of money to make it nicer, and in doing so is going to be able to sell it relatively quickly again on the market for an accretive price, or a price that's higher than what they initially they initially spent. They want to be able to understand how they can validate that information. And so we work to be able to provide them a lot of the due diligence information, such as the appraisal, such as the contractor's budget, and our analysis upon that, directly within the offering itself. So it's easily digestible. They don't have to do a lot of complex calculations on their own. They can understand how we reached the decision that we did. And assuming they've worked with us before, they have a level of trust that we know what we're talking about. But because the opportunity is easy enough to understand, it's not something where you have to have 12 MBAs and be a quantitative genius to be able to really understand how the subject or the sponsor is going to make money. Very, very straightforward. And so we've had a strong advantage in being able to offer that.
Very interesting. All right, so you've talked about deal flow as being a current challenge. What other challenges do you face at the moment as you steer the ship of Patch?
To be honest with you, it can be much, much more simple to run a 10-person company than it is to run a 100-person company. You've got an order of magnitude different roadblocks when you start to get to the point where you don't organically understand everything that's going on within your company. You have to rely on a very, very skilled set of managers, executives, to be able to help distill what's going on in the company to me personally, so I can make a good informed decision. But on top of that, just in the operations of the company itself. So we get in thousands and thousands of leads per month. So we have to be able to quickly qualify those leads, be able to contact those leads, be able to appropriately quote those leads, then take those quotes and then close them on a fairly complex, well-regulated transaction, such as a real estate transaction, in a very short period of time. And the ability to, and then close them on a fairly complex, well-regulated transaction, such as a real estate transaction, in a very short period of time. And the ability to make that into a routinized system can be challenging, especially as we get larger. I mean, we're doing, early on when we were doing 2 or 3 projects a month, it was relatively easy to be able to understand exactly what was going on at that particular time and understand what you needed to be able to do to accomplish those projects, be able to accomplish getting those things through the door. Now when we're dealing with hundreds of opportunities per month, there's definitely a challenge in making sure that you've got a good process flow, making sure you've got a set of good controls, so if something does go wrong, it's fixed immediately, and mistakes aren't propagated all the way through the system to the point where they cause. I need to make sure that my company investors are seeing a good return. And company investors make money off of growth, not off of profits or cash flow. So we need to be able to show continued growth. And luckily for us, it's a massive industry that was fundamentally broken to begin with. So we have a long range of growth yet to occur before we hit any sort of plateau. but that all needs to be managed, and it all needs to occur in parallel with running a good, respectable business.
All right, so let me ask you a question about that. In terms of screening out the deal flow that you're getting on a monthly basis, as large as it is, have you considered or do you do any third-party screening for those deals?
We really don't at this point. We've internalized all the processes of the company itself. In fact, we've built a great deal of custom solutions on the engineering side as well. Once you start using too many third-party processes, outside of marketing, we obviously will use resources and marketing channels that are external to ourselves to bring in opportunities. But as far as processing, the workflow itself, we want to make sure that we don't have any, or too many at least, external dependencies. That if they fail and they're outside of the control of the company itself, that it significantly impacts our business. And we try to make sure that we keep things internalized as much as possible. However, I know that other companies have had great success in distributing the workflow externally.
Okay. Let me ask you one more question about Patch of Land and then 3 wrap-up questions, if I may. So about Patch of Land, what is the future for Patch of Land? Where do you see it being in 5 years or 10 years' time? What state industry will look at that time?
I think as far as Patch of Land individually, in 5 years' time, we'll have a true national footprint. We'll be well known in this particular industry. We're already gaining a great deal of market share as it stands. But we'll also have a true cradle-to-grave offering for our clients as well. So that if they're offering, if they need to have a good project completed or funded, that we're able to say yes, no matter what the asset class is or whatever the duration is, or whatever the product actually is, from new construction ground up to short-term bridge financing to traditional long-term to portfolio lending to lines of credit. We'll be able to offer that, to which case our offerings themselves will be significantly more mainstream perhaps than they will be today. And on the crowd side, the crowdfunding side, I think that over the next 4 years you're going to start to see that become much more mainstream as well, but it's going to be integrated with traditional finance as well. One of the exciting developments that we've seen is we have these very powerful Wall Street firms coming in and investing fractionally alongside of our crowd. So our crowd is actually on the same level playing field as some very sophisticated, very, very powerful hedge funds and firms that operate more traditionally. And I think that as we become even more connected, and as this type of investment opportunity becomes more known and more recognized, I really think that you're going to have more of a direct access to the retail investor than what has been possible in the past. And I'm pretty excited about that. I think you're going to start to see a lot more opportunity for unaccredited investors to invest in these type of opportunities. And I think you're going to start to see the regulatory agencies get much, much more comfortable with allowing access. I personally believe that you shouldn't have to drive a Mercedes or a Ferrari to be able to make smart, direct decisions with your own capital. I think that the regulatory agencies are starting to recognize that as well.
Very nice. Jason, what a pleasure. Let me ask you 3 wrap-up questions, if you don't mind. What are the key daily habits that you have that make you and your business successful?
Personally, I think, 1, I eat well and I get exercise. If you don't have a level of energy or a strong level of energy, it's going to be difficult to run a rapidly growing company. I always suggest to the young people that I met, win or lose, you're going to learn more doing that than you will anything else in the rest of your life. However, you have to have an enormous amount of energy. There's so many things that will come out of left field that you're not expecting. You have to be able to deal with that. 2, I arrange a good amount of time, half an hour to an hour or so at the very beginning of the day, where I do not have a specific task set before me. But I use that to set aside to specifically organize the rest of the day in my mind and get prepared for it. And then two, I never put off till tomorrow what can be done today. Because eventually I meet a lot of people who have very hard decisions to make that don't make those decisions quickly. They put it off until they have to make that decision. And the problem is when you do that, they tend to pile up on you. And eventually it gets to be overwhelming, and you can have kind of a catastrophic breakdown at that point. So they tend to pile up on you. And eventually it gets to be overwhelming, and you can have kind of a catastrophic breakdown at that point. So make the decisions now. If you have to work a little bit longer today, a little bit longer tonight, or get up a little bit earlier to get a little bit more time in, get everything you can done today and only put off till tomorrow what you absolutely has to be put off till tomorrow. And then finally, it's just honestly a matter of attitude. Honestly, I've started up several companies now at this point. I've gone from earning an enormous amount of money on an annual basis to having nothing almost overnight. And the only thing that's allowed me to keep going and then to start over again and to grow into something that's become amazing is the idea that I can do it. You will get an enormous amount of criticism from folks who don't believe in the idea or don't believe in you, and it can be challenging. A whole person in general is the confidence that you can do it and the ability to make yourself do so.
Well, that's really fabulous advice, Jason, seriously. Resonates very much personally for me. All right, so the second question, what has been the hardest lesson you have learned in real estate, but you can also apply that to business. I know you've had some hard lessons. What would be the hardest lesson you've learned, either in business or in real estate?
I've learned that not to expect everyone else to look at the same situation through the same lens that I do, both in real estate and in business. In real estate, a project that I may think is amazing may be looked at as completely worthless by somebody else, or vice versa. That somebody's visions and dreams are very meaningful to them, may be completely unworkable to me. And in business, that's the same thing. That somebody's visions and dreams are very meaningful to them, may be completely unworkable to me. And in business, that's the same thing. I know when I started, I was shown the door by one of the most prominent real estate brokers in the Chicago area. She seemed to be personally offended at this idea of bringing in retail customers online to help fund a project. I'm not sure exactly why it was so, but she thought it was the worst idea ever, and it was just rife with danger. And she wouldn't even listen to me any further, and that was very early in my career. From my perspective, this seemed like a no-brainer at all. And as I worked forward here in over the course of my career with this company, I've found that you have to be very patient. You have to work very hard to understand the perspective of the folks that you're working with, even if they differ vastly from your own, because we're right. Their perspective often has a great deal of value that you can learn from.
All right, my last question. If you could give one piece of advice to somebody who has not yet invested in real estate but is considering investing, what would that advice be?
I would say look at the opportunity objectively. A lot of people tend to get very tied up in a romanticized vision in their head. I found that it can be very easy to find good projects. They're everywhere out there. You have to be able to look at it from the lens of a business person. You have to be able to look at it in an objective sense and be able to take a look at the numbers and say, okay, here's what happens if this problem comes up and how I'm going to recover from that. Just don't get too attached to it. There's other projects out there. If it doesn't make sense in your mind, if you're looking at it very, very closely, drop it and move on. But do move on. Those projects do exist, and you can find them, and you can find them on our...
Thanks to also students at the Ophelia School of Business at Cal Poly San Luis Obispo. This semester, I'm providing them with 10 weeks exclusively focused on the wonderful world of crowdfunding as a new avenue for providing real estate finance. They will all take my online course, Principles of Crowdfund Real Estate Investing, be privy to the various chapters in my upcoming book on the origins of crowdfund real estate, and we will look at a couple dozen case studies of actual deals. Promises to be a fun-filled, if slightly exhausting, 10 weeks. Now, the only reason for explaining how much teaching I'm going to be doing coming up is by way of making an excuse that the podcast may not come out with quite the regularity I might otherwise prefer. That said, all being well, my guest next week will be my fellow London School of Economics alum, Dror Pollock, who explains how private equity works and the possible impact on crowdfunding, or of crowdfunding, I should say. Be sure to subscribe to how private equity works and the possible impact on crowdfunding, or of crowdfunding, I should say. Be sure to subscribe to the podcast series on whatever platform you use for podcasts at the National Real Estate Forum.org website, nreforum.org, and hitting any of the links that I have included about halfway down the page. Thanks for tuning in, and thank you also to Jason Fritton of Patch of Land for sharing your time with me today. Until next time, this is Dr. Adam Gower, signing off.